I guess I'm live. Let's see. Okay, connection is good. Let's see if you guys can hear me. Yep, so basically you guys can hear me, and today I wanted to show you this website. I don't know if you guys know what this website is, but this website is basically called Finviz. Just a small thing. The screen, I have two screens, one for the laptop that I'm streaming with, and the other one is the screen that I'm looking at over there. So I might not be looking all the time at the camera, so there will not be an eye contact. So I'm gonna probably be looking at the screen most of the time, and from here to there I'm gonna look at the camera, which I hope, it's not gonna be a problem for you guys. Today I'm gonna talk about this website over here. Basically, I don't have any agenda of what I'm gonna talk about, but I'm just gonna show you this website and why I like it. And I think it's a good website for all of the people who are into investing or trading, maybe, because it kind of gives you, an overview of the markets, an overview of insiders buying or selling their shares in companies. Let me go through it and you'll understand why I like this website. One thing important to note over here is that the prices that you see of the stocks are delayed or updated every 15 minutes. So if you go into this website, you're 15 minutes in the past. If you want live action of prices, don't go on Finviz, go on Google, go on CNBC, any website that you want to go to, but don't go on Finviz if you're looking for, every minute of price changing performance of a stock. So that's an important thing that I had to disclose over here. And another thing I want to disclose over here is that I'm not getting paid by Finviz. It's not a promoted video. I just want to add value to you guys, and I like this website a lot, and I think you're gonna like it too. So let's go through the features of this website, and I'm sure you're gonna like it. So basically, one of the things that I like the most, and I think they are cool for this website, is this thing over here. Okay, this is a heat map of the S&P 500, and over here you can see the stock performance by sector or industry. Let me do something like this, and you can pick, first of all, the map filter. You can look at the S&P 500 stocks, you can look at the world stocks, and what I like over here is that you can see also the performance within, let's say, a week. So we're looking at the Friday close. Today is Sunday, there's no trading, and we're looking at the Friday close, and we can see that Tesla went down by 6.6%. We can see Amazon fell also 1.24%. But if we take a look at 1 week performance, for example, we can see that the market actually did okay. Amazon is up 4.33%, and Google is also in the green, and Apple is also up 1.7%. And we can see, I want to show you over here that if we take a look at the energy sector, okay, let me move myself a little bit. If we take a look at the energy sector over here, we can see that the energy stocks are starting to fall, and growth stocks are starting to go up. The reason for that is recession fears. Recession fears actually causing oil prices to fall. Okay, and the recession fears are also causing the yields to fall. and that causes that leads to a rise in growth stocks. If we take a look at 1 month performance, you can see a pretty nice picture over here. Look, you can take a look and you can see that Amazon is up 21%, Tesla is up 17%, Apple is up almost 13%, Amazon is up 5.5%, Nvidia is up 20%. So we are in a bear market. Okay, don't let anyone fool you. We are in a bear market, and within bear markets we also have bear market rallies. Okay, so a bear market, for those of you who don't know, is basically when the stock market falls 20% from its highs, more than 20% from its highs. A correction is if the market falls more than 10%. So we are in a bear market. The S&P 500 fell, especially the Nasdaq fell more than 20%. And if we take a look at the year-to-date performance, which is pretty ugly, you can see over here that Google is still down almost 19%, Amazon is still down 15%, Tesla is still down 18%, and the best performers year-to-date are the energy stocks, the ExxonMobil, the Chevrons of the world. They're doing very good. Okay, and one stock I want to show you over here, which is Occidental Petroleum, which actually sounds like a Harry Potter curse or spell. Occidental Petroleum is up 100% this year to date. In the last 12 months, the stock is up 103%. And Berkshire is still buying shares in Oxy. They're still buying shares in Oxy. They're bullish on Oxy, which is kind of amazing to see that the market somewhat agrees with Warren, of course, and the stock is up more than 100% this year. So this is one of my favorite features over here. I like to go and check what stocks did at the end of the day, what the stocks did for the week that passed or year to date, and we can tell if there's a change in sentiment, if something is going on. Let's see, do we have anyone watching us? Nope, no one is watching. Okay, it's fine. We'll keep on doing it. We'll have some people will watch, if not now, later. Another thing, guys, that I want to show you that I really like about this website, which is another feature, and it is, let me show you why it's not transitioning. Yep, now it will transition. Yes. So let's go back to the main page of the website. You have something called Insider over here. So when I click on this tab, I can see the transactions made by companies' insiders, and it's a pretty good indication whether the insiders are bullish or bearish on the company you're looking at. So this tab is basically one of the first things that I look at when I start looking for a company, because it could be a good start point for researching a company. Why? Because if you see that, let's say, WD-40 over here, WD-40, you have the director bought 500 shares. Okay, so if you see that WD-40 director bought shares, if you see that the CFO bought shares, if you see that the CEO bought shares, if you see that the insiders are accumulating a lot of shares, well, it could mean one thing. It could mean that either the insiders are trying to show a sign of confidence in their company, or the thing that's more likely is that the insiders are very bullish. Bullish mean that they are optimistic about the upcoming future of the stock or the company that they're working in or they're investing in. So this could be a good indicator for us as, you know, the small average investors, to go check what's going on with the company that we're looking at or we're looking for. So you can also, by the way, change. Let me show you. If you go over here, you can filter from buy transactions to sale transactions, meaning you can also see which CEOs or insiders are selling their shares in certain company. You can see also all of the transactions. Okay, but I like to go and look at the buy side. I like to go and look at the buy side to see how the insiders are treating their own shares, if they're selling them or if they're buying them. And it's pretty good indicator. I can tell you from my own experience, during one of my classes in my MBA, I had to manage a portfolio, and me and my team were looking for stocks to start investing in. And I was doing exactly what I'm doing right now in front of you. I was looking at insiders buying or selling their shares, and I saw that a lot of insiders were buying shares in Ulta Beauty Salon, if you know the company. And Ulta actually posted bad earnings one quarter before, and the stock went down probably by 30%, if I'm not wrong, after they released their earnings. And lo and behold, after they released their earnings at some period of time, the insiders were buying a lot of shares. And that was a starter for me, that was an indicator for me to go and start looking for, what's going on with the stock. And I looked and I saw that the company is actually not a bad company. It's not gonna go bankrupt. And if anything, the insiders are buying a lot of shares. And it wasn't cheap, but it wasn't expensive. It was selling at a fair price, even though they fell by 30%. And I went to my team and I told them, that was my pitch basically. I said, listen, the stock fell 30-40% because of bad earnings results and worse expectations for the future. And here we go, we have insiders buying like crazy. And if we put 5 or 6% of our portfolio in this company, the worst case scenario is, let's say the company get cut in half, which we will lose 2.5% from our total portfolio. And the best case scenario is that they beat expectations, and the company will, explode on earnings or after. And we collectively, unanimously said that, we're gonna buy 5 or 6% of our portfolio, put 5 or 6% of our portfolio in Ulta. And the stock soared on earnings. It basically went more than 15-16%, if I'm not wrong, back then. It was back in 2018-19, if I'm not wrong. And so I like this indicator over here. I like this tab over here because it shows you how insiders are feeling about their companies. And Peter Lynch once said something very correct. He said that insiders may sell their shares for any reason, but they buy new shares for one reason only, and they're just bullish. They're bullish. They have, good expectations about what's going to happen in the future. So, screener is the second thing that I like about this website. The screener is basically a filter. Okay, you can filter the stuff. Let's see. Streaming. Okay, doesn't matter. We're gonna keep going even though we have only me watching myself over here. The screener is basically a filter where you can actually pick your favorite ratios or metrics that you wanna look for when you're researching a stock. Okay, so when I look at the screener, I look at a couple of important things. The first one I always pick here, I always pick country, I always pick the US country. Okay, I look for companies that are USA based, US companies, and especially I do that right now because of the recent bear market we had. Prices dropped very, very much recently, and you can find bargains, and you can also look for companies in certain exchanges. You can look for NASDAQ, you can look for New York Stock Exchange. Market cap, you can pick also the market cap that you want. You can look at only mega caps. You can pick only micro cap stocks. You can pick mid cap stocks. So you can choose whatever you want. I have no preference when it comes to these. When it comes to market cap, I have no preference. I know people that love looking at micro or small caps, which is understandable because when the moves are micro caps and small caps, to the good and for the bad, by the way, you might have 20, 30, 40% price increase or price decrease in a couple of days, sometimes even in the same trading day. So if you're more of a person who likes stability, go for mega caps. Don't go for micro or for small caps. It's not for you. You can pick also the index, S&P 500, Dow Jones, sector, what you want to look for. And I like to look at this one over here, fundamentals. The fundamentals is basically the most important part of investing. You want to have good fundamentals on a company that you're looking at. And you can start by looking at the PE ratio. So the PE ratio is basically tells you how much dollars you're paying for every $1 of, oh my god, the PE ratio tells you how many dollars you're paying for $1 of earnings of a company. So, generally a low PE is a good thing for us because that shows that you're paying less dollars for the $1 of earnings. But the PE by itself doesn't tell you if the stock is cheap or not, because sometimes a low PE ratio is basically low for a reason, and it could be a manifestation of market participants basically already discounting future deterioration in earnings per share. So the P stands for price per share and E stands for EPS or earnings per share, and once you divide them you'll get to the PE ratio. A high PE is usually associated with high growth stocks, and this is a very important piece that I should talk about over here, because if you have a stock that's selling for, let's say, 60 PE and the stock is growing its earnings per share by 100% a year or 150 or 200% a year, then the PE is not a good metric to look at when you're measuring or when you're trying to figure out if the stock is overpriced or not overpriced. You better look at something else. So I like to put low PE below 15, and you can also look at this one over here, which is price to sales ratio. I like to put under 1, and I'll explain what is a price to earnings ratio. So as we said with the P is the price, the P over here is also price, and the S is the sales, basically the trailing 12 months sales or revenue. So this indicator shows us how market participants are viewing our company that we're looking at. It could show us that market participants are overly optimistic or overly pessimistic about the stock. It shows you how much dollars you're paying for every dollar of sales of the company. So I like to put under one, and usually stocks that are selling for under one price to sales ratio treat me well. Let's just put it that way. Of course, they have to have some. Good tailwinds behind them, and if they're selling for a low price to sales ratio, if they're selling for a low PE ratio, and if they're selling for a low debt to equity ratio, which we'll come to right now, then you might be looking at a bargain. Then you might be looking at a stock that's selling for a cheap price, and you might be up to something. So if we take a look at debt to equity ratio, okay, and let's say we will put also low, which is lower than 0.1%, the filter spits out for us stocks where they have low PE, a price to sales ratio under 1, and debt to equity ratio of under 0.1. Okay, well, debt to equity ratio practically shows you how the company is structured. If you have a lot of debt and if you have a lot of equity, okay, debt is how the company basically finance itself from getting debt from banks, and equity is the money that been put by the shareholders. The lower the better. That's what I look for. And I can see that Build-A-Bear, which is a stock that I invested in, is still here. It's still here. So Build-A-Bear is basically a very boring business. It's a business where you see people going to build bears, teddy bears. Okay, they stuff their bears, and it's a nice experience for kids. I know that some also adults go there and do it. And it's a company that I invested in, I think a year ago. I will show you. A year ago, and it was selling for a cheap price. It was selling for probably $4 or $5, something like this. And it's still cheap, statistically it is a cheap stock, which why I put money again in it. By the way, I didn't invest a lot of money now. I just put some small amount of money in Build-A-Bear again. But if you take a look, you have a company that has a market cap of $247 million, and sales is the company's sales for the last 12 months are $437 million. Which means that the price to sales ratio is 0.57%, meaning that it's lower than 1. That's why it showed us over here. And then if you take a look at the PE is 5, meaning that for every $1, for every dollar of earnings, you're paying $5. Take a look, like over here you can see a lot of information about the company that you're looking at. Here I'm going to do it like this. You can see insider transactions. Basically, it's not good. Insiders are selling their stocks over here, but they can sell for many reasons. It doesn't mean that they're selling because the stock or the business is not going to do well. They probably, just want to cash out. You have also return on assets, return on equity, return on investment. You have short ratio. You have how many shares outstanding. You have so much information on this website that you can basically just, skim through it and see that just basically know a lot of things about your stock. When I invested in Build-A-Bear, it was also selling for a very low P price to sales ratio, and it had also a low PE ratio. And I was and it was, by the way, shorted a lot. Like it was, people were shorting it. more than they are right now. Right now it's like 13%. I think it was more. I don't remember actually this metric, but it was short to do. That's what I remember. And you know, we were going out of the pandemic, and I was thinking to myself, you know, there's like a lot of tailwinds right now for this company that's selling for this cheap, and they were expecting that revenues would grow, and it was actually expected. You know, people were gonna go back to stores and they're gonna go and buy things and go out and spend money. And I looked on YouTube, and I tried to see, you know, I tried to see like what is the experience, like how people actually go there. And I saw many videos from back then. It wasn't like a while ago, where people are actually going with the masks and everything and going to buy their beers. And I'm looking at the comments, and everyone loves this store and loves this business. And I was like, okay, you know. And I looked at the fundamentals. It wasn't expensive, it was cheap. And I put money. I think I put, when it was $6 or $7 per share, and I made my first bagger over here for 2021, I think. Yeah, 2021. My first bagger for 2021 was in Build-A-Bear. So, long story short, Finviz is a good website. Let's see what something else you can. Well, that's basically it. You know, this is what I wanted to tell you guys today. Go for Finviz. It's a good website. I'm not getting paid for this, by the way, so don't think I'm promoting anything over here, just for you guys. And for those who are traders, you can also see like all of the, you know, people who like looking at trends or signals or whatever. You can see it over here too. This is basically it. Yep. Oh, let me show you one thing also. For example, if we go back to Build-A-Bear, if you scroll down, okay, there's like loads of information about the stock. Many websites, or many articles from different websites that you know, are added over here that has to do with Build-A-Bear. You see, and it's basically a, you know, it's a good website for these things, where you can just go through and read about the stock. One thing you should pay attention to, sorry, when looking at or investing in a stock like Build-A-Bear, is that you have very high or very explosive price movements. See, like the stock could plunge 23%. The stock can go up 23% in one day, because it's not a mega cap. So that's basically it, guys. I hope you had fun. I hope I added value for you, and see you in the next video.